So before we start, I want to let you know that if there's ever a topic you want to hear about on our channel, please let me know in the comments below. We are always looking for topics that people are interested in, and direct requests from viewers are much easier to address than just guessing about what people want to see. Now, as it happens, I received a question from a viewer not long ago asking my thoughts on whole life insurance versus term life insurance. So we're actually going to address that in this video today. Now, if you want to retain viewership on YouTube, it's not a very good strategy to give the ending away at the beginning of a video, but I'm going to do that now anyhow. My answer to the question is that I can only think of two reasons to purchase a permanent life insurance policy, and they're both estate planning strategies for wealthier individuals. They have nothing to actually do with insuring someone's life or replacing the income they produced during their life anyway. If you want life insurance for its most common purpose, that is to cover those who depend on your income in the event of your untimely death, then I strongly recommend term life insurance, and I'll explain why in just a minute. But first, I want to talk at a high level about the two reasons someone might actually want to buy a permanent life insurance policy. So here's the case for permanent life insurance. We'll start by making a semantic clarification. Whole life insurance is a type of permanent life insurance. There are several others, universal, variable, and variable universal being a few of the most popular. And from this point forward, I'm just going to lump them all into the permanent bucket because I don't think any of them are very useful, with the following exceptions. First, there may be a case for using permanent life insurance to cover the cost of estate taxes after your death. In 2024, each individual American has a lifetime gift tax exemption of $13.61 million American dollars. And that basically means if you die in 2024, you could have given away up to $13.61 million in your lifetime completely tax-free. Now, if you're married, you both get the exemption, but since couples rarely die together, Form 706 should be filed with the IRS to reserve the exemption of the spouse that passes first. But ultimately, all this means if you have an estate worth more than $27.2 million, you should probably look into how a permanent life insurance policy could protect at least some of your estate from estate taxes. No, this does not apply to very many people. Now, the second case for permanent insurance will also likely only make sense for wealthier families who have assets that will not divide very easily after their death. So for example, suppose there's a couple named John and Jill Smith, and they own a business that's turned into quite a valuable organization over time. So valuable, in fact, that it represents 80% of their total net worth. Now, the Smiths have two sons. John Jr. has worked in the business for years and is all set to take over when his parents pass away. The Smith's other son, Tommy, is an engineer who works and lives over 1,000 miles away. Now, John Jr. and Tommy get along great, but the Smiths know that leaving 80% of their net worth to the older brother could create a bit of animosity after they pass away. They desperately want to equalize the inheritance. Now, there are a few ways they could do this, but one way is to buy a permanent life insurance policy at such a value that Tommy will receive an inheritance that is somewhat equal to John Jr.'s. Now, in addition to businesses, real estate is a common asset that can be difficult to divvy up, creating another common use for this type of insurance. And I've heard arguments that permanent insurance should be used to protect disabled heirs who can't care for themselves. I'm not going to shut the door on that method entirely, but in most cases, I think there are better ways. And these alternate approaches are all rooted in the basic truth that permanent life insurance is far more costly to you and your estate than term life is. Let's take a deeper look at that now. All right, let's talk about why term is better. I'm not going to belabor the point here. The bottom line is insurance companies love selling permanent insurance because they make a ton of money on it. Typically, the agents that sell whole life policies receive a commission of somewhere between 60 and 80% of the value of the premiums you pay in the first year. So for a $500,000 whole life policy sold to a 30-year-old male in good health, that's a little over $4,300 in commissions from one sale alone. So the ton of money that insurance companies make on permanent policies comes from exorbitantly high premiums, protected by exorbitantly high surrender fees, paid by exorbitantly mistreated insured parties. Can you tell that I don't like permanent insurance yet? Well, unlike permanent insurance, which is incredibly complex and expensive, term life is simple and cheap. You can buy term life insurance for only the amount of time you need it, and the premiums are far, far more affordable than a permanent policy. Now, as it happens, my wife and I wanted a bit more term coverage a little while back, which required us to collect quotes from our insurance company. For kicks and giggles, while I was getting the term insurance quoted, I also requested a quote for a whole life policy. I want to walk through an analysis of the total cost differences and benefits between that term life policy we actually ended up buying and the whole life policy I was quoted. But first, if this information is helpful or interesting to you, please consider clicking like and subscribe below so you can receive notifications about future videos and I can continue producing content about personal finance. All right, let's talk about the math of term life versus permanent insurance. Now, in our situation, that is my wife and I, we were shopping for $1.5 million in coverage for each of us, and we wanted the policy to last at least 10 years. And I knew the whole life premium would be high, but I did not expect this. So on your screen, you can see the premiums I was quoted. These premiums are for me only. I was the only one that actually got the quote for permanent insurance. We didn't get that from my wife, although it was a little cheaper to insure her. Now, I was 42 when I got the quotes for this insurance, and to be fair, in the case of the term policy, the insurance company just had to hope that I made it to 52 years old. I'm in good health, and I plan to do my best to make it at least that far, so the odds of them ever having to pay up on that policy are pretty low. On the other hand, with a whole life policy, if I ever die, which seems like a likely thing to happen, they have to pay out a $1.5 million benefit. This means with a permanent insurance policy, the insurance company is basically promising that they'll make this payout at some point. And as you might expect, it takes a lot of money and time to build up $1.5 million in assets. So out of curiosity, I looked up my life expectancy when I was evaluating these policies. I had 37 years to go according to the mortality information I found. I hope to do better than that, but we'll go with this for the evaluation we're going to do in the video. So what you're seeing on the screen now is how much I would pay in premiums over the course of 37 years. Like I said, the monthly premium for permanent insurance was $1,266.61. The term life policy was $54.15 per month. Over the course of 37 years, I would make 564 whole life policy payments for a total of $714,368.04 and 120 term life payments for a total of $6,498. Again, the total costs are vastly different. Now, you'll note the total expected premium for the $1.5 million whole life policy is less than half of the total benefit. Well, that's because the insurance company is going to invest the premiums I pay them each month in order to make up the difference and produce a profit. In a way, when you buy a whole life policy, you're paying an insurance company to invest the additional premium value so you don't have to. And they're good at math, so they're happy to take the deal. With that in mind, let's look at what the value would be if you invested the $1,212.46 difference each month in premium payments between term life and whole life, and what it could earn for you instead of earning for the insurance company. So what you'll see is the value of each policy after 5, 10, 20, 30, and 37 years. There's also a 23-year, 3-month point in there I'll talk about in a second. And basically, the term life policy is worth $1.5 million from the day you buy it, right? If you pass away, that's what you'll get for it. For the permanent insurance policy, I went ahead and just set the value at $1.5 million all the way through the term of the policy. Since the whole life benefit is $1.5 million, that's the value of the policy for the remainder of your life. Even if the policy has a cash value feature, the death benefit will almost certainly be reduced if you access the cash value. Most of the values in the term life column are the compounding effect of that $1,212 premium difference invested each month in an S&P 500 index fund, earning an average rate of 10.67%, which is the average annual rate of return for the S&P 500 since 1957. Now, the value at 5 years is almost $1.6 million for the term life policy because you have a $1.5 million insured benefit and another $96,420 in portfolio value from the invested premium difference. Once the term life policy expires at 10 years, everything from that point forward is the result of investing the premium difference. There's no more insurance benefit. So in summary, if I died between 10 years and 23 years and 3 months, the whole life policy would have been the better way to go. I don't know the odds of passing away in that time frame, but I'll be 64 when the 23-year window passes. According to the Social Security Administration, there's a 1.88% chance that I'll die before then. The really wild thing to see is that over 37 years, my whole life expectancy, the term life policy will allow me to earn almost 5 times as much as the whole life policy would benefit. There are a few takeaways I want to highlight from this. The first one being that the math is very clear. Whole life is not a very efficient way to provide life insurance coverage. Also, if you elect to buy term, and I think you should, you need to be investing to build enough assets so the life insurance is no longer needed once the term policy expires. $1,212.46 a month is just under 20% of the median household income, in case you're wondering. The third thing is the earlier you can buy life insurance, the cheaper it will be. This is true for permanent or term insurance, so don't delay on that if you know you're going to need it. Another common rule of thumb is to buy 10 times of your income in insurance coverage. And a rule of thumb is an accurate characterization. To really identify your exact need, you need to dig into the numbers and evaluate your income, your cost of living, both now and in the future, the ages of the people you're insuring, the sort of expenses they'll experience. Are you going to upgrade in house? Will you have more debt or less debt down the road? It's also helpful to make some assumptions about inflation. You really want to try to be as accurate as you possibly can so you buy an insurance policy that really meets your needs. And the last thing is, when in doubt, buy a little more insurance and a little longer than you think you'll need it. Term life coverage is actually quite inexpensive, assuming that you buy it at a young age, so it doesn't really cost you that much to have a little extra. Now, somewhere out there, there's a life insurance salesman who thinks I'm calling him a bad guy. And I'd be a little shocked if I don't hear from at least one or two in the comments below at the end of the video. And while I fully believe that there are people who sell these policies to anyone naive enough to buy them, I think the majority of the time the people who sell insurance like this are only given tools by their employers to sell the most profitable products to clients. Now, if you needed to sell hammers to feed your family, you would get really, really good at finding nails. After a while, you might even decide that a lot of things that aren't nails are close enough to justify the need for a hammer. Eventually, everything becomes a nail. And in insurance, there isn't a fiduciary standard requiring insurance salesmen to act in the best interest of their customers. Heck, they may not even know the alternate options exist because their employers don't want them to. Can you imagine what a mind-blowing experience it will be when they're given their first screwdriver? The truth is there are a lot of options, and they all need to be considered so you produce the best outcome. Now, to learn more about those, we have tons of information on our YouTube channel and our website at martinmoney.com. As always, we are grateful for your interest. God bless and take care.